Hi, good morning, good evening, everyone. So yes, it's 7 now, so maybe we should get started. So my name is Sunny from Digital Sales team at Saxo Capital Market Singapore and the host of your tonight webinar. So a very warm welcome once again and thank you so much for taking your time to joining us today. So we are happy to inform you that today content brought to you by Saxo in collaboration with the State Street Global Advisor at SGA, and we are very honored to having with us today from at SGA is Claressa Wong from SPDR ETF Fixed Income Specialist APAC, and also Maria, also SPDR ETF Fixed Income Strategist. Um, from at HGA. So as you can see, the today topic is very interesting. It's about income generation through bond and ETF. And hopefully after the session, we can deliver it to our audience some idea and also the trading inspiration in 2023 and beyond. So yes, should you have any question along the way, do feel free to pop them in the chat, and then we will address in a few questions at the end of the session in the Q&A. All right, so before we get started, I would like to show you our disclaimer for today. So today the presentation is brought to you by Saxo Capital Market is for your general knowledge and information. So it does not include any financial advice. So please make sure trade only after you acknowledge and accept the risk. Okay, so our webinar today will take you about 45 minutes, and this is the agenda for today. So to kickstart the webinar properly, I will be sharing with you a quick introduction about Saxo Trader Go platform, and also for the special edition today, where our partner and also ourselves giving away our gift, a free gift at the end of the session. So please stay tuned until the end of the session. So the next 20 minutes will be followed by the sharing on the today topic, again, income generation through bond and ETF by Claressa and Maria. It will be amazing sharing section today, I promise. And so we will be I have some time like around 5 to 7 minutes for our Q&A where we will be addressing most of your question, and we will be close up the session with some closing remark, and we will be releasing the promo code to redeem the free gift. So stick with us. So let's get started. Maybe we can do a quick introduction on our Saxo Trader Go platform, our award-winning platform. So as you can see from here, so to access the Saxo Trader Go is really easy. So you can either go to the URL link www.saxo.trader. Saxo Trader, sorry, let me repeat again. So you can go to the URL link www.saxotrader.com, or you can go to our official website, Saxo Capital Market Singapore. You can click to the login button here, right here, and then you will be able to see. So for Saxo, we do offer different platform to suit the client need, and both of them are available on the browser mode and also on the mobile app, which you can easily download from the respective app store, and this allow you to trade on the go. So it's very convenient for our client. Okay, so let me show you how to build a diversified portfolio through our award-winning platform, Saxo Trader Go. So when you log into Saxo Trader Go platform, this is what you can see. So this is our main screen, three window for you to see watch list, screener, and also product overview. If there is some ongoing position or order, you will be able to see as well. All right, so for the interest of time, so I will be showing you today our watch list and also screener function that available on our platform. So for our watch list, if you want to build a diversified portfolio, you want to keep an eye on different instruments across different asset classes, so you then can do your personal watch list to monitor them. So very easy to create a watch list on our platform. You can just simply log into the platform. On the first window, you can see watch list right here, and then you can click to new. So you can name your watch list. So let's say today at HGA, our partner, save the watch list, and then you will be able to see your watch list right here. Yes, so if you want to add some instrument, let's say today topic is about fixed income bond ETF. I will just do some search. Let's say SPDR S&P 500 ETF trust. Just simply just click on the instrument and it will be added to the watch list that you created earlier. Or alternatively, you also can consider to search for the instrument on the top right hand corner on the instrument search. So again, yeah, simply just search for the instrument that you have in mind and you want to keep an eye for. Yeah, at the moment, you can just simply search for the instrument. Let's say Amundi right here. You can just click here. Yes, so on the product overview page, simply see the start right here icon. You can just click to the star icon and then add to the watch list. So the watch list I just created at HGA, let's add to at HGA. So here you go. You have a few, yeah, one or two that you have in mind in your watch list right now. Okay, so moving on to the screener function. So you can just simply using the screener function to sort it out some of the instrument you have in mind to take a closer look. So for example, today webinar, so we will talk about ETF and we will choose the fixed income. You can filter accordingly according to what you need at the moment. So yeah, fixed income. After I'm done right here, you can just press done. So yes, so the system will sort it by different category that you are referring to see. But for now, I will choose last 3 month popularity trading directly from the platform by our client. So yes, you can see right here. Yeah, it's quite a number of ETF, and you also can add the instrument directly from screener to the watch list. So simply just right click on the instrument, add to watch list, and then you can see at HGA right here. Okay, you will see right here for the watch list. So yes, especially if you should you be interested or want to explore more on the fixed income ETF or any other investment option on the Saxo trader Saxo platform, you can consider to take a closer look on our research tab. So for Saxo, it's very special. We categorize the instrument based on their current performance and also the morning star rating for your ease of evaluation. So yes, you can take a look right here. I will show you roughly how it look like on our research tab. Okay, so yep, that pretty much about Saxo Trader Go platform. For the one of the main function that we feel that really useful for a client when they first started or even the existing client want to monitor the portfolio closely. Okay, so as mentioned earlier, so there will be the special edition today where we giving out our door gift, from Saxo and also from at FGA. So this it will be a little sneak peek on what you can redeem at the end of the session. So make sure that you stick with us until the end. We will be releasing the promo code for you to redeem. Okay, so with an understanding on the Saxo Trader Go platform, it will bring me an honor to hand over to our webinar partner, Claressa and Maria, who will bring us to today topic, again, income generated through bond ETF. Okay, so I will pass over the mic to our speaker, Claressa and Maria, please, over to you.
Hi, good evening, everybody. From the State Street Global Advisors team, I'm Clarissa, and I'm responsible for SPDR ETFs fixed income sales for APAC ex Japan. And alongside me is Marie, our APAC SPDR fixed income strategist based out of Sydney, who will be sharing a few insights into bond investing in the current market environment. So in advance of our presentation, please note that should there be any product-specific questions, please reach out to Sunny from the Saxo team or your Saxo representative whom we will work with to provide you an answer. So kicking off with a quick introduction to who we are, State Street Global Advisors is the asset management arm of State Street Corporation, which is the second largest custodian bank in the world with almost 11% of the world's financial assets entrusted to us. So State Street Global Advisors has 3.48 trillion US dollars in assets and is the world's fourth largest asset manager and a pioneer in ETF and index investing. With over 2,100 clients across 57 countries, we manage assets for clients from official institutions, insurance companies to private banks. SPDR, okay, Spider, the team that we are part of, is part of the asset management business that focuses on ETFs, from the creation to the management and distribution of ETFs. We also look after the ETF ecosystem from a liquidity perspective by managing relationships with authorized participants and market makers. We are the third largest ETF provider globally, with approximately 1 trillion US dollars in AUM in ETFs split across equities, fixed income, and commodities. Over the 45 years since SSGA was established in 1978, we have seen many milestones, like the 30th anniversary since SSGA launched ETFs and the establishment of the SSGA office in Singapore in 2000. On the broader market, we have seen a rapid growth in the ETF market since its introduction in the 1990s, and the global ETF market has built up a fantastic momentum over the last 5 years. The COVID-19 pandemic has further highlighted the resilience of ETFs and its growth potential. Having steered through the market uncertainty and volatility of 2020 and 2021, ETFs are emerging from the crisis stronger than ever. Global ETF assets under management have reached almost 10 trillion US dollars in 2022, with an expectation that it will hit 18 trillion US dollars by 2026. And specifically on fixed income, we saw the first fixed income ETF launched in year 2002. And in the last 20 years, fixed income ETFs have grown to 1.6 trillion in assets, representing 19% of the global fund market as of June 2022. As we all know, 2022 was a challenging year for both fixed income and equities, marked with lots of volatility as central banks tried to contain persistently high inflation by increasing interest rates. And even with high rates, total bond returns were negatively impacted in 2022 due to the inverse relationships of rates and bond prices caused by the bonds being repriced lower as interest rates went up. Despite this, we saw inflows into fixed income ETFs in the US hold steady, with approximately 200 billion US dollars in inflows in 2022 as bond investors selected precision investments that enabled them to control credit quality and duration exposures. Now, with inflation potentially tapering off and markets expecting interest rates to peak and come down this year, was I would like to turn over to Marie to ask her, what do you think investors can expect in 2023?
Thanks very much, Clarissa. Well, let's take a look at the macroeconomic backdrop in 2023. We're looking at materially subtrend growth, looking at expecting growth recessions in both US and also Europe, with a reopening rebound in China. The second theme, macroeconomic theme in 2023, is that the disinflationary episode is starting to unfold. So, disinflationary simply means that inflation reaches its peak and reduces from, the very high levels that we have seen, gathering pace. Over 2022. And the third macroeconomic theme is policy uncertainty. So central banks are now followers and not leaders. They want to see the data shift first, and then the central banks would take action. But as you know, it takes time for interest rates to take effect. So the uncertainty and the risk is when the data signals a deterioration, it is almost too late for the central banks to take action. So turning to page 9 now, 2022 was indeed a volatile year for bonds, with most sectors down. Page 9, just the one before. Um, uh, yes, there we go. So most sectors were, in fact, down in 2022, but toward the end of the year, and as we headed into 2023, markets rebounded quite strongly. So the 3 months to January, the end of January 2023, have delivered gains, as you can see, shown on this chart, the 3 month to January returns being in the light green color. It really helped to offset the losses over the 12-month period to January, and the 12-month period returns are highlighted there in the blue bars. Meanwhile, the orange dots represent the yields that investors could lock in as of the end of January. Now, page 10 looks at some trends, longer term structural trends that we are observing, and why we believe that the longer term trend for interest rates is really in a sort of downward trajectory. As developed economies like the US mature, GDP growth slows and US aggregate bond yields slow to a similar extent, as you can see on the right hand side chart there. And this is not just a concept in developed economies that we see things like aging demographics, as you can see on the chart on the left hand side. This is data coming out of the US, but even data coming out of China, which is the world's second largest economy, shows that the demographics there are similarly affected. So we believe up in interest rates. So with the US Fed having moved quite aggressively, which is the case with a lot of central banks globally, the bulk of the rate hike cycle is really now well and truly behind us. And the rolling over of inflation figures has markets even pricing in potential cuts to the US Federal Reserve's policy rate by the end of the year, despite the fact that the Fed is in fact signaling that they would not cut this year. Are we able to switch the slide to slide 11? Great. ETF fund flow data from the US, where markets are deep and liquid, indeed support the view that investors are now finally seeing value, with 18.5 billion US dollars flowing into investment grade corporate ETFs, 6.5 billion into government bond ETFs, and 5.7 billion US dollars into aggregate ETF exposures. And these are based on observations on US ETF listings. Now, among government exposures, investors are buying into the intermediate and long term interest rate part of the curve. They've attracted flows of 6 billion US dollars each, while the ultra short end of the interest rate spectrum is in outflow year to date, and the sort of short interest rate risk has been in outflow over the month of February. Let's turn to page 12 and take a look at our views on the corporate segments or the credit exposures of the fixed income market. Now, the ETF flow picture that I just described is consistent with our views looking forward in the credit space. In the investment grade space, these credits are supported by positive fundamentals, and they are compensated, investors are compensated by fairly high all-in yields. They are also not penalized for taking shorter term interest rate risk either. So for instance, an investment into a short duration investment grade corporate can yield as much almost as the full duration investment grade corporate exposures. On the other hand, taking a look at the sub-investment grade exposure or your high yield or sort of junk bond category of bonds, now they have always been a higher risk, higher return category of exposures. But because a growth downturn is widely anticipated, investors have been cautious. We certainly do receive a lot of ongoing client inquiries about high yield. We do caution that the investor needs to be able to tolerate a level of short term volatility. Um, the projection is that there would be a slight increase in defaults, which is not as high as historical recessionary scenarios. But keeping in mind, valuations could be impacted, so the credit spreads could be expected to widen if defaults pick up meaningfully, and that has negative impact on valuations. We have seen outflows from US listed high yield ETFs in February, and we believe this is largely due to investors taking profit after having achieved about a 9% return in US dollars in the US high yield space in the 4 months to the end of January 2023. Page 13 touches on emerging market debt exposures. And, in 2022, emerging market debt has seen the double headwinds of the war in Ukraine, the Russia invasion of Ukraine, and subsequent sanctions against Russia that have been imposed. And also, the other factor that had been weighing on emerging market debt for most of 2022 has been the strength of the US dollar. Now, as you know, there are two key types of emerging market debt exposures: hard currency and local currency. And for both these types of exposures, in 2023, um, we would need to see further unwinding of the US dollar strength that has gathered momentum to see an improvement from a rates perspective for emerging market debt. And when it comes to the emerging market local currency debt, we would also see this benefiting from a currency perspective should the US dollar strength unwind. Now, talking about US dollar strength, let's go to page 14, where we show some charts on the likely trajectory going forward and also what the US dollar has also done historically. Now, we believe that the US dollar currently is overvalued and should, over time, pull back by about 10 to 15% over the next few years. And well, when this happens, it can actually happen very quickly because currency moves can be quite volatile, and it's due to a number of reasons, including carry trades, which is when investors borrow in one currency to invest in assets in another currency. And of course, when currency moves, the momentum builds on itself, and sometimes these carry trades, when they're unwound, have very meaningful impact on FX volatility. By keeping in mind that in order for the US dollar to weaken, certain conditions do need to be met. We have to be on a path to a more sustainable growth recovery globally, as well as not just growth, but inflation outlook as well. And also, the second thing is that monetary policy needs to normalize. Now, if growth and inflation are either worse or better than expected currently, the US dollar, it's easy to see how it could stay strong in the short term, even if we believe that it might come off in the longer term. Might hand back over to you, Clarissa.
Great. So turning back to income generation, following all the interest rate hikes, we are finally seeing income back in fixed income. So Mary, where do you see pockets of better opportunity to lock in good levels of income?
Sure. Page 16 highlights some of the yields, the prevailing yields that we are seeing in the market, and puts it with reference to the types of yields that we have been able to see in recent history. And when I say recent history, it's over the past decade worth of yield data that we have gathered there. So this is your standard box and whisker plot. The green boxes represent the 25th to 75th percentile, and the dots represent where the yields were at the end of January. And as you can see, it's most of the yields there, if not at the top of historical ranges, are at least in the sort of top quartile there. So quite high against what investors have been able to access in recent years. Now, of course, you highlight the fact that there are risks ahead potentially, and yes, definitely, returns and yields generally are commensurate with the level of risk that the investor is taking on. So, high yield as an investment, generally speaking, as we've covered before, does tend to deliver a higher income than investment grade corporates, but they are a lot more sensitive to a growth downturn. Emerging market debt, which we've covered before as well, there is a risk associated with this investment, and it hinges on the ability and the willingness of the bond issuer to repay its debt. But then it's also subjected to other things like geopolitical risks, as we've mentioned, in terms of the war in Ukraine, and even factors that are outside of emerging markets can weigh on the asset class. And again, we sort of mentioned US dollar strength, but also when you see developed market growth concerns developing, then that also tends to have impact on emerging market assets more broadly. Now, page 17 is a summary. The next page from here is a summary chart which shows our capital market assumptions or our expected returns over the medium term, which is a 3 to 5 year horizon, as well as a longer term 10-year horizon. So the top chart is our current return expectations, and comparing them with the end of 2019. You can see that the main difference there is an uplift in the return expectations in bond space. And so when we speak with clients about building income portfolios, we do like to check that over their investment horizon, and that's specific to every individual, the expected return needs to be supportive of the income level. So these return expectations are provided by the State Street Global Advisors Investment Solutions Group. It is a portfolio management function at our firm, and their core role of this team is to manage multi-asset portfolio asset allocations, which is why the short, medium, long-term return expectations as well as risk expectations are very fundamental and core to what they need to do. So I think that really wraps up, our topic on income. There are a lot of opportunities in fixed income now, more so than ever in the previous decade, and it's good opportunity for investors to consider fixed income investments in 2023.
Great, thanks, Marie. So beyond income, as investors are increasingly concerned about the possibility of a recession, as markets are afraid that central banks are unable to orchestrate a soft landing, how would economic uncertainty affect bonds, and what role can bonds play in an investor's portfolio?
Great. Thank you for that question. It's a great question. And the good news is that there's a big role that fixed income can play in a broader portfolio given the risks of recession ahead. So, page 19 of the presentation shows us that, really. Going forward, investors have valid concerns about the economic growth situation. US has a 65 probability of a recession over the next 12-month horizon. This is the median analyst forecasts. In the Eurozone, it's more 54% area. It's much lower in Asia, which is interesting to note. Singapore, Southeast Asia, China are all sort of 30% probability or below chance of recession in the next 12 months. Now, the chart here shows, the volatility index. This is an equity volatility index there, and it shows the sort of correlation with recessionary periods. So, when you see economic downturns, usually you'll see a lot of equity market volatility right around that time, or maybe even slightly before that time. So, the two sort of go hand in hand in terms of economic uncertainty, or concerns about economic growth being sort of subpar, and this equity volatility. And usually when we say equity volatility, it's usually a drawdown in equities that we see in equity markets. Now, so what does this mean going forward? Page 20 highlights the fact that we're actually in a little bit of a transitional phase. So since the global financial crisis, now this is back in 2008, when the major economies weakened, the central banks would very quickly come in and inject liquidity, or to lower rates, or they might actually do both at the same time, as they sort of had to for the global financial crisis, and again during the COVID crisis that we saw play out in the early 2020 period. Now, the fact that central banks could quite quickly and readily intervene, that resulted in a period of what we would like to call great moderation. So we saw steady increases in equities with relatively limited drawdowns. But going forward, with higher levels of inflation, the same central bank strategy just can't be relied upon. They can't just cut rates now, because there are implications to do with inflation. And so we would expect, with central banks' hands being tied in that way, we would expect larger and more protracted downturns in equities as and when they happen. So then you might ask, what's the role of fixed income in all of this? So the next page, page 21, it shows, the correlation between returns in equity space and bond space. Now, the sort of negative correlation, or even a lack of correlation historically between fixed income and equity, is the main argument for diversification, because, what that means is usually when equities are going down, your bonds are going up. And so it helps to offset some of that volatility that you might otherwise see in an equity only portfolio. So in 2022, we have seen that breakdown in the historical relationship between bonds and equities. There is now a slight positive correlation between that two asset classes, but we do still believe that fixed income does play a role in diversifying a multi-asset portfolio, and it still makes sense for an investor. Well, why? Well, historically, an investor could put their bond allocation into, say, all into US Treasuries if they wanted to. That would have just helped them to offset equity losses very well. And in fact, the US Treasuries was actually the best out of all of the developed market government bond categories in terms of having that good relationship with equities, offsetting equity losses. It sort of really pulled its weight in terms of against all the other government exposures, like in Europe, like in the UK. And now, of course, having seen that long-term relationship broken down, you actually could argue that an investment portfolio needs the fixed income exposure that is diversified in and of itself. And what we mean by that, we'll show you on the next page. So the next page is a table of results. We've done some analysis and we've taken 3 hypothetical portfolios. We use index returns to sort of simulate what would have happened in these portfolios. And as you know, index, assumes a lot of different things. Very importantly, it assumes that there's no fee impact and things like that. So please do take our results with a grain of salt. But what we wanted to highlight is that because all of these portfolios are built up out of index exposures, the same lack of fee situation applies. So what we're really looking at is the relativity between portfolios 1, 2, and 3. So let's take a look at each of them in turn and why we have built them out in the way that we have. Now, first portfolio there, we have 100% Singapore equities, and this analysis is done in Singapore dollars, relevant for our audience here tonight. So 100% Singapore equities, and you can see, we've got a annualized return over a 20-year historical period. We've got the risk there. And we also have a measure of portfolio efficiency in the Sharpe ratio, and with the Sharpe ratio, the higher the number, the more efficient your portfolio, the more diversified your portfolio. So explaining the role of fixed income as a potential diversifier in the portfolio. But of course, a lot of clients say to us, well, Sharpe ratio, it's a little bit too intangible. I want to really know what that translates into in my own portfolio. So then you can see we have also laid out the performance of these portfolios under certain historical scenarios. So during the global financial crisis, and during the Straits crisis, and then also during the COVID crisis, as we've mentioned. And you can see in each of the instances that if you just had an equity only portfolio with a home bias, so domestic bias towards Singapore only, the drawdowns, the negative numbers, that's your negative performance over those challenging market environments. But if you were to add bonds to your portfolio, so you have a portfolio that is 60% Singapore equities and 40% bonds, then you can see, in fact, your drawdowns over that period are less in magnitude. And that is because for part of the history, the bonds would have had a negative correlation with your equities. So while equities went down, bonds might have gone up. In the most recent scenario in 2022, we did see equities and bonds end the year of 2022 down. But in those 3 months where we saw a significant downturn in equities, fixed income did not fall to the same extent. So in effect, if you like, it is your sort of if it wasn't the negative correlation between fixed income and equities, then it is the more stable portion of your portfolio. So it doesn't fall as far. That explains your return experience in hypothetical portfolio 2. In the third hypothetical portfolio, which is portfolio 3, we wanted to draw out the benefit of diversification within both of the sleeves of your portfolio. So you have global diversification for half of your equity portfolio, and then you also have a global allocation over half of your fixed income portfolio. Now, we've just assumed for the purpose of this exercise that the global bond component is in fact hedged back to Singaporean dollars, which is a little bit of a convention, but of course not all investors choose to do it that way, but this is how we have designed our hypothetical portfolio number 3. And you can see that at each point, each step of diversification, whether you diversify by adding fixed income to your risky asset portfolio, or whether within fixed income you introduce things like global diversification, each step that you take helps to reduce the drawdown or the sort of pain of challenging market scenarios and helps smooth out what could otherwise be a relatively volatile ride. Back to you, Claressa.
Great, thanks for sharing, Marie. So to wrap up what Marie shared in three key takeaways, we see that the higher rates are bringing income opportunities back to fixed income. Two, we are also constructive on investment grade credit rather than higher yield credit. And three, fixed income may provide diversification during periods of downside risk and higher volatility. So I would like to turn it back now to questions and to Sunny.
Okay, thank you so much for sharing, Clarissa and Maria. So this is a very valuable insights, and I think this is a very interesting and informative topic today. So we do have quite many questions from the audience, but I will pick the most popular one we'll ask in the chat box, and the rest we will address them via the email later after the session. So Maria and Carissa, how do you think about which type of bond that can investor consider for their portfolio in the current market condition? And do you have any view on the US or European or local Singapore bonds?
Great. Thank you so much, Sunny. Of course, we can provide very general comments. Our comments are general in nature and do not take into account individual circumstances. But when you look at the, fixed income spectrum of investments, there is really something for everyone. For those who are more risk averse, the risk-free sort of rates, which is US Treasury rates, are quite attractive. And even when you take the 1 to 3 year type exposures, the shorter duration exposure, you're not heavily penalized compared to the longer term duration exposures. If we were to say generally, we probably would prefer to take interest rate risk over credit risk. If we were taking credit risk, we probably would prefer investment grade credit over high yield credit, just as a generalization. And if you're saying globally, there are good reasons why you might want to invest in US fixed income, because it's generally more of a safe haven. US dollar has sort of worked in these assets' favor over the course of 2022. And of course, given where things are at with the US dollar, our teams are looking at US fixed income exposures. And we also think that, just generally speaking, really helps to round out your portfolio. And of course, for a Singapore investor, it definitely makes sense to have Singaporean bonds in that mix. What we would actually say is, we kind of favor Asian bonds more broadly as a category, because that gives you an element of diversification, because not all of the central banks in Asia are doing exactly the same thing. So in 2022, we saw a lot of central banks in Asia, raise rates. That's certainly consistent in the sort of Southeast Asian bloc. But if you consider, for instance, China, they have maintained a very accommodative interest rate policy to support the economy through their sort of zero COVID policy. And now that they're, reopening, they're still keeping monetary policy relatively accommodative. And when you have that, mix, a diversity of interest rate cycles through your exposure in your portfolio, that does give you true diversification within your portfolio of fixed income exposures. Hopefully that helps to answer the question.
That's very clear. Thanks a lot for answering the question. So, yes, again, due to the time limit, so all of other question, we will be addressing them via the email that you use to register your webinar today with us. So please no worry, all the question will be answered after the webinar. Yes, so you can see on my screen right now is the QR code for you to scan if you are not able to attend the webinar or you want to watch this again. So it will be made available after 3 working days on our social media and also our YouTube channel, Saxo Market Singapore. So you can, and also if you can scan the QR code to sign up for more exciting series of the upcoming webinar. Okay, so Yes, so the webinar is coming to the end, and as promised earlier in the beginning of the session, so will be our promo code for giving away. This is the promo code, and the first 10 people attending the webinar today, all you need to do is to email the promo code SAXO SHGA to us at ps@saxomarket.com, and you will be able to walk away with the free gift from the SHGA to be collected at our newly opened Saxo office, Capital Spring, and along with $20 commission credit from Saxo. So once again, email the promo code and then you will walk away with free gift and commission credit. So please note that it's the first come first serve basic on the Saxo description, and the commission credit term and condition apply. And also, if you watch the recording of the webinar after today, after 3 days, available on our social media and Saxo Market Singapore YouTube channel, you can always email to us and to get some free gift as well from HGA if while the stock lasts. So yes, once again, Kalesha and Maria, thank you so much for answering all the questions, sharing a very insightful topic today for us, and thanks for spending your valuable time to conduct the webinar today with us. It's our pleasure having you tonight. And don't forget a big thank to our audience for our participating our webinar today. And I myself and also we at the Saxo and our partner at HGA hope that today's sharing will be useful when it comes to making your future investment decision. So yes, so last but not least, if you do not have a Saxo trading account with us and you can't wait to take a look closer at our fixed income ETF topic today or any other investment trading option, so do visit our Saxo official website. You can open the Saxo account. It only takes roughly 10 minutes from online via my info Singpass. Yes, so I think that should be all from all of us. And once again, thank you everyone for joining us and have a good night.
Thank you, Sunny. Thank you,
Thank you
everyone.
so much.